What's up, guys? So today's episode, we're going to talk about things that I have done and I do in my practice, and I teach my clients about what you can do to help your kids out for their financial future. And what I mean by that is there's a lot of things that a parent can do behind the scenes to help their kids out, and a lot of it doesn't really cost any money. So we're going to go over those things. The 5 things that we're going to go over, the 5th one is a little advanced. You see it all over social media, and it's got to do with real estate, but you see it all over social media is go buy your kid a $200,000 house, which is fucking ridiculous. It's ridiculous. 90% of the people in the United States that have children, that have jobs, how many people of the working, we're talking about a husband and wife, regular 9-to-5 jobs, or maybe self-employed or whatever, but how many of them are just sitting there with $100,000 sitting in the bank, especially if you have multiple children, to go do that? So it's not a thing. So my advice is more on a practical realm of what anybody can do. And so we're going to go over that. So again, my name is Gus Robertson. I have 5 kids ranging in age from 20 all the way down to 1. So 20, 17, 6, 3, and 1. And these are the things that my wife and I do to help all 5 of them. Even though the older 2 are not hers, we have a plan for all 5. And so this is what I do. So when each of my older girls turned 15, I added them on. This is number 1. You add them onto your credit card as an authorized user. You don't have to give them a credit card or anything like that. But the point of that is anybody that tells you that your credit does not matter or you don't need credit to buy anything, that's foolish. Dave Ramsey and preaches a lot of that. Well, you just pay cash for everything. But at some point you are going to need credit, whether it's to buy a house or buy a car or whatever. Even auto insurance companies use your credit score to determine if you have a preferred rate or not. So you adding a kid to your credit card just helps them. You just have to make sure that as a parent that you're paying the credit card and that you're using it wisely. One thing that we decided to do for each of our kids is and I just did it for my 20-year-old about 6 months ago. So what I did is, and she has a job, so she's a full-time student and she has a job. Her income is probably anywhere between $15,000 and $20,000 a year as a student, and so she makes that amount of money. What we did is I started a Roth for her. Now, when you're above the age of 18, then it's her Roth. If you're below the age of 18, it's called a custodial Roth, meaning that the parent owns the account. But for my oldest daughter, who was 20, I did a Roth. She can contribute up to $7,000 a year into that Roth. $7,000 sounds like a lot of money, and it is a lot of money, but what she did is she is going to contribute $100 a month, and we are going to put in $100 a month. And so at 20 years old, and I went through this on a previous episode, the point behind doing that is if she contributes $200 a month minimum for the next 10 years and then just stops at age 30, this is an example, she'll have $1 million in there when she's 60, just at regular market rate returns. And so you have a lot of parents that are super concerned about leaving their kids well off. And this is one thing that we can do now so we don't have to worry about it later or be concerned about it later. We've set them up very easily for $100 a month. And I was thinking about that this morning. That's $1,200 a year for my 20-year-old. A lot of people waste that amount of money on their kids on stuff that they just don't need. And so when people say, oh, well, $100 a month is a lot, well, do 25, do 50, do something to set them apart and give them an opportunity. So again, you're not having to worry about it later on. Savings. So my daughter is required, and she's had a job. My daughter started working when she was 16. She worked at Texas Roadhouse, and she made very little money. But my deal with her is 50% of everything that you make goes into your savings account. Birthdays, it doesn't matter where the money comes from, 50% of everything that you get goes into the savings account. And I will say that there was a point whenever it was kind of pointless to her. But whenever she saw the account really starting to grow, it became like a game to her. She enjoyed it. And you know, it got to the point at you know, I mean, we're talking about a kid that was probably 17, 18 years old. I mean, she had $7,000 or $8,000 in there, and that's way more money I had when I was 17 or 18. That was my money. The point behind that is not the saving of money, because we can get into inflation, we can get into why even have money in savings. The point behind money and contributing to a savings account is to start the habit of saving money. How can she go do these things later on that she wants to do if she has no money? And so it's just a habit. It's being consistent with just saving. And by the way, that savings account that she contributed into, she's put money towards her car. She's paid for her own tires. She's paid for tinting her windows. And she's just paid for things that she wanted out of that money. She's paid for a vacation, a $1,500 vacation. But then as soon as she came back, she started putting money back into it again because she saw the point of doing it. Next thing is college. You know, college is a big deal right now. You know, unfortunately for all of us, college is very expensive. But I think that I see a lot of parents make a huge mistake in regards to funding of college. And what I mean by that is parents taking out parent co-signed loans to send their kids to school really hurts a parent, because now you have a loan on your credit that you are responsible for. And now it really hamstrings parents in their ability to borrow money and save money for their future. How would you like to, you know, for me, if I was to pay for my 20-year-old to go to school and I co-signed with her a loan for that, and let's just say when she was done, it was $100,000 at $1,000 a month payment. Now that's on my personal credit. It affects my ability to buy a home, buy a car, buy anything, because I'm ultimately responsible for that $1,000 payment. So my advice for that is you need to talk with your kids about, number one, how expensive college is. Number two, most jobs, whenever a kid graduates from college, I think that's a big issue for today, is borrowing money to go to college. But then whenever you graduate from college, the job that you get, which is very easy to find, the job will not afford for you to make that monthly payment. It is now a burden that you are saddled with for many, many years. So as an example for that, let's just say that my daughter graduates from college. And let's just say 4 years and at $20,000 a year for college. And when she's done, if she did have school loans, it was $100,000, and the payment on that with interest was $800 a month. Well, even if she were making $100,000 after taxes, that's 70 grand. That's $6,000 a month. That means that $800 a month of her monthly income is now being put towards a school loan, as an example, which is ridiculous. So I think that parents need to have a good conversation with their children about how much college costs. Stop making promises that you can't fulfill. You don't want to back into college expense. You want to know what it's going to cost. And if your kid needs to go to a different school that's less expensive, then that's how it goes. That's my advice. But I think that not being in the know in regards to what college costs is really putting parents and kids in a bad spot financially. And the last one, and this is number 5, this is where I was talking about real estate. For us, what we want to do, and that we are going to do this, in fact, next week we're closing on a house that's specifically for my 20-year-old. What we're doing is we are buying the house, we're fixing the house up, and then she's going to live in the house, and she's going to have 3 roommates. And then eventually, and that costs very minimal money. Just like in a previous episode, what we talked about, it's more time and effort in overseeing the project. And there's a lot of ways to do this where, you know, a lot of people, whenever they do this, and it's really ridiculous, it really comes down to this, the education part of it. When you hear people talk about this, about buying a rental property for their kid, all I'm doing is helping set my kid up for future financial success. But my 20-year-old is fully in the know of what the responsibility is. And of course she'll make mistakes, but it puts her in a position to do really well without having the burden of trying to figure out how she's going to start her financial life. And so I think that this is just simple things that parents can do. And what I was going to say a while ago is a lot of parents say, oh, well, I can't afford to do that. Well, how do you know that? How do you know that you can't afford to do that unless you ask the questions on how it can be done? So here's my example on this. I sent about 50 letters out to a certain area of our town where I wanted her to live. 50 letters. I typed up 50 letters and mailed them out. And I got one letter back. And it just so happened to be from a letter from a guy that I knew 20 years ago, and his mom passed away. So I was able to buy this house for roughly about $180,000. I worked with a local lender for very minimal money and classified it as an investment property. So I paid $180 for the property. It's going to take about 40 grand to fix it up. And then once the property is fixed up over the next 90 days, we will turn it over to a management company, and my daughter will go in it with a lease, and 3 other girls will go into it with a lease. And now the bank is going to let us borrow the money back that it took to buy the house, as well as the fix-ups, and the rent's going to cover the payment. And that house will eventually be hers. And so there are many different ways to do things like that. So again, the things that we talked about to help your kids out, the free things that really cost no money were, of course, the credit card, teaching your kids about savings, the money that they make, starting a Roth IRA for your child once they are of age, 18 or older. It costs very little money to do that. I guarantee you the amount of money that you could put into it once they have a job will be offset by the money that you're not having to give them because they have a job. And so, so there is that. And then there's college. You know, the big thing about college is, again, positioning yourself where college is not a financial burden for you, which is pretty easy. It may hurt your feelings to tell your kid that they can't go to a certain school, but because of the cost. But that college is not, college is so expensive that you're not trying to hurt yourself financially. You're not trying to just be a burden. And then the last thing, which again is kind of advanced, but then the whole rental property thing is huge. But to set your kids up straight. These things are just what I tell my clients, how I help them do this. If you have any questions about this, just drop them in the comments. Appreciate you listening.